and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today is Craig Jeffery, Managing Partner at Strategic Treasurer. Welcome back, Craig, to another episode of the Open Treasury podcast.
Yeah, it's been a while. It's good to be back.
We truly appreciate your time and insights as we explore critical topics shaping the landscape of corporate treasury management and beyond. In today's edition, we shall discuss 4 topics, namely generative AI insights in treasury and finance, TIS to serve CFOs as an orchestration layer for the cash conversion cycle, US Treasury ready to make the bond market more resilient, and finally, new use cases push global real-time payments to record highs. Our audience can watch videos on the CTM File YouTube channel and explore insightful articles, interviews, and industry roundups on ctmfile.com, either by visiting the website or by following the links provided in our show notes. Let's commence today's discussion with our first story, which is about generative AI insights in treasury and finance. Amidst the evolving landscape of technological innovation, the prominent emergence of artificial intelligence or AI and generative AI with their significant promise and potential has captured the widespread attention of treasury and finance professionals, prompting them to experiment with these technologies both personally and professionally. However, beyond the customary hype that surrounds emerging technologies, are there substantial grounds for treasurers to focus and support traditional AI and generative AI so their organizations can effectively harness the combined strengths of humans and technology? Treasurers are unequivocal in their support of AI and generative AI, as shown by their actions and expectations to roll out AI in the near term, stated the 2024 Generative AI in Treasury and Finance Survey report, underwritten by the Cash Management Leadership Institute and powered by Strategic Treasurer. In this standalone survey, the actions, attitudes, and plans of corporate treasury executives and providers, including fintech and banking respondents, are meticulously documented. Craig, can you share some of the key findings of the 2024 Generative AI in Treasury and Finance Survey report, and why, according to you, should corporate treasury and finance professionals download and review the report?
Well, I think for downloading the report, most treasury professionals are interested to see what their peers are doing, thinking. And so normally you'd want to do that anyway. But let me go through some of the details. This is the first time we've done AI and Gen AI as in a focused report, particularly with regard to treasury. So we looked at how people were using AI today, both for personal use and corporate use, what their expectations were, their awareness of how that's being used, what their plans were, their plans to use, and what we found with regard to some of the different topics that mattered, things like forecasting, certain areas around payments, payment security, least cost routing, but also, and some of those are in use today to a certain extent through vendor products, vendor provided products, but there's also a number of other areas that people are contemplating for the future, like manual reconciliation tasks, which there's an area, for accounting, there's an area for treasury that touches on these, including areas like creating draft reports for internal use. Going against data and text to create those, there's expectations that will be used, and things like risk management generally. While lower than some of these other areas, there's certainly an expectation that AI will help identify risk, help calibrate those risks, bring those forward. And, that's a movement and a shift from some of the programs that look in your ERP to figure out what's going on. But some of the specifics on the personal use and business use side, the banks reported a greater self-reported level of awareness of AI and Gen AI than the corporate treasury practitioners. Yet the corporate treasury practitioners used it personally more than the bankers did. So there's a little bit more use there. And there's a pretty significant level of use by both firms. But expectations to use the technology on the corporate side was well over 60% within 2 years. In just those two areas or three areas we mentioned. We had 9% currently using it for forecasting, and 8% and 9% using it for one of the two different payment areas, using it for payment security activities as well as for, optimizing payments generally. So, only 8 or 9% currently using it, but both of those areas, payments as well as forecasting, the expectation is it's going to be quite a bit above 50% within 2 years. That's a really rapid adoption. It matters what people actually adopt versus what they say. And what we've seen so far in AI and APIs, not that this is part of the survey, but APIs and AI, we've seen companies have adopted it faster than they've said they're going to adopt things. Usually when people say they're going to do things, there's a discount off of it. In other words, there's other competing priorities and projects that come in. So 60, 65, 70%, tend to adopt it, that say they're going to adopt it. Whereas we've seen it with AI, APIs, where the number's higher. So we have pretty strong expectations because adoption's been faster and higher. It's supported by the technology provider. So those are a couple of the key areas. You want to keep going on, or do you have more questions as I'm talking through that?
No, Craig, that should help our audience understand why it's important for them to download the 2024 Generative AI in Treasury and Finance Survey report from Strategic Treasurer's website, which is strategictreasurer.com. Thank you so much for highlighting the key findings of the report.
One other thing, too, on the use of generative AI and AI, evaluate and recommend investment options was identified as a yes by 36% and no 42%, or unsure rather 42%. I think that's kind of interesting because you can read some of the other articles on what ICD's doing to use AI to help with things like counterparty risk and then ultimately investments. I think those are good things for people to contemplate.
Well, we'd recommend our audience to go and download the 2024 Generative AI in Treasury and Finance Survey report, powered by Strategic Treasurer and sponsored by the Cash Management Leadership Institute. Please go to the website strategictreasurer.com and download it today. Let's now shift our discussion to the second topic, which is about TIS positioning itself to serve the office of the CFO as an orchestration layer for the cash conversion cycle. Successful business operations depend on efficient cash flow management, wherein the cash conversion cycle, or CCC, is a crucial component that cannot be overlooked. The cash conversion cycle is the measurement of time it takes to convert resources into cash flows. Corporate finance and treasury professionals regard the CCC as a vital metric that offers valuable insights into cash flow management for companies aiming to optimize financial operations and maximize operational efficiency. Understanding the significance of the cash conversion cycle, Treasury Intelligence Solutions, or TIS, is positioning itself to serve the office of the CFO as an orchestration layer for the cash conversion cycle. In this context, TIS, a leading player in cloud-native cash management, liquidity and payment solutions on a global scale, has revealed the signing of a binding agreement for a majority growth investment from Marlin Equity Partners. This investment will empower TIS to pursue a range of strategic opportunities, both organic and inorganic, thus enhancing its ability to meet the evolving needs across the office of the CFO. Marlin's knowledge of both the European and US markets and experience covering the office of the CFO will facilitate TIS's acquisitions, strengthen product development, broaden partnerships, and expand sales. Marlin's acquisition of a majority stake in TIS will also help TIS establish as an orchestration layer for the cash conversion cycle. Craig, can you, for the benefit of our audience, explain what your understanding is of this strategic positioning by TIS to serve the office of the CFO as an orchestration layer for the cash conversion cycle?
It's an interesting choice of terms, orchestration layer. If you think of an integration layer, you think of passing files back and forth or passing data back and forth from one system to another, but it's referred to as an orchestration layer. And as you hear the excitement in their voice as they talk about, not only do they act as a treasury aggregator of sorts where information is passed back and forth, payment information and payment hub functionality exists going out, their vision is broader, and the acquisitions that they've made, folding in Cashforce and other functionality into their platform, helps us understand the orchestration layer. Instead of just transforming data, handling payment hub, this idea of not only connect to my banks, but also to my ERP systems, my treasury management systems, recon platforms, and the like, that gives them the ability to have a very broad connectivity layer. So from an orchestration layer perspective, it takes a mindset that I'm not just passing data, but that data is gold. Data is the new gold for an organization. And what do I have to do with data? And I don't really know that much about mining gold or other things, but you're mining the ore, the underlying material. You find the ore, you mine it, then there's a refining process, and there's using it. I don't want to belabor that particular point, but their view of data as gold and useful for the organization for everything from forecasting to modeling to seeing that value across the enterprise is what makes sense to them. So if data is the gold, where is the gold stored in the ground? Well, there's multiple places. So data in a company and finance is in lots of different silos or stovepipes, depending on what area of the country you're in. It's in these different areas. And to leverage it, you have to get at that data and make it so that it's available from a broader view. Everything that's in a particular stovepipe, if it's in the ERP, you can access it in the ERP. If it's in the treasury system, you can access it in the treasury system. A recon platform, an admin system, all have their own areas where they store data. If data is the new gold because it provides broader insights, pulling that together across different areas makes sense. And so as an orchestration layer, it's pulling the data together, putting it in a data lake, allowing organizations to take advantage of, I'll call it the orchestration layer, what he calls the orchestration layer. All this data is now available for management analysis. And so it's a gold in the ground doesn't add as much value as gold collected and being able to be used. And that's what it is. So it's pulling the data together, being able to analyze it, orchestrating across the different silos in a company. I think those are a couple of the key areas. So think of data lakes. Well, this is moving information back and forth, storing it in data lakes, and being able to interrogate that, inquire that. That's a different value proposition than what many organizations look at.
Well, Craig, your discerning perspective is greatly appreciated. Next up, let's delve into the third story, which is about the US Treasury ready to make the bond market more resilient. The US Treasury has announced the launch of the Treasury buyback program to improve liquidity in the Treasury market. According to a recent Dow Jones report, the goal of the program is to support liquidity in the world's largest market for government securities. Concerns over the US growing debt pile is regarded by traders and strategists as one of the biggest catalysts for a prolonged period of volatility inside the US $27.5 trillion Treasury market. The Treasury Department has only undertaken two previous series of buybacks, the first taking place in the 1920s, and more recently, Treasury bought back US $67.5 billion of outstanding debt via 45 operations held between March 2000 and April 2002, according to Josh Frost, Assistant Secretary for Financial Markets. In a speech last September, Frost said that reintroducing buybacks would not only help to make the Treasury market more liquid and resilient, but would also help the department achieve its debt management objectives. Craig, do you concur with Josh Frost's opinions that reintroducing the long-awaited Treasury buyback program will make the Treasury market more liquid and resilient?
As we think about what's going on here, I think this provides for more stability in the short term, but that doesn't fix perhaps the long-term machinations of what's going on. The fact that there's a significant increase in the level of debt, you can't increase debt ad infinitum, without limit. I remember it wasn't that many years ago we were talking about, getting over 100% of debt to GDP. The U.S. is well over that. Japan's far over that. Other areas are over that. So we were stretching past what we thought was a limit not too long ago. And that's a concern, especially as interest rates are off the floor. When interest rates were zero, extremely low, it didn't matter as much. So in the short term, the fact that there's more liquidity, you can sell these securities, sell and buy them. The market has additional fluidity. That's great. But there's an endpoint. So in the short term, this is excellent, but you have to solve the longer term issue. I think that's the concern. That's something that has to be solved with perhaps more significant actions over time, not growing debt with no end in sight.
Thank you for sharing your valuable viewpoint, Craig. Let's move on to the fourth story, which is about new use cases pushing global real time payments to record highs. Global real time payments growth has reached sustainable levels with 266.2 billion real time payment transactions recorded in 2023, a year over year growth of 42.2%, according to the 2024 Prime Time for Real Time report published by ACI Worldwide in partnership with Global Data. This year's report takes a deep dive into five of the most successful real time payments markets worldwide: India, Brazil, Indonesia, Malaysia, and the Netherlands. Analyzing the driving factors and use cases that have allowed those countries to develop thriving real-time payments ecosystem with the power to transform businesses and improve consumers' lives. However, US banks are failing to meet demand for instant payments, according to research from Red Compass Labs. Its report, Time to Leave Legacy Behind Instant Payments in the US, has revealed nearly two-thirds or 63% of US corporate bankers experience significant or overwhelming demand for instant payments from their corporate customers. Yet, at best, less than a third of US banks are signed up to RTP and FedNow, which means less than a third can offer instant payments as a service. More than a third of US banks are concerned about updating their core infrastructure to handle the increased volume and speed of transactions. Other challenges include 24/7 availability, cannibalizing other revenue streams, and choosing between RTP and FedNow. Craig, as the world's biggest economy, the adoption of real time payments in the US has been surprisingly slow. From the US corporate treasury perspective, do you think there are lessons that the US can draw from the most successful real time payment markets? Or do you think the US should take its time to implement instant payments into the national financial ecosystem?
Well, I think every country, every payment ecosystem has to handle faster payments. Speed isn't everything, nothing's getting slower. And the idea that we need to carry more information more richly makes sense. That's why we see infrastructure projects where all the underlying systems are moving to an ISO 20022 standard for sharing information, more consistent, more rapid. These are essential things just to move forward. Speed does matter, as I mentioned, but it's not everything for every use case. And you can see, as you went around the globe a little bit about like India, the rise in the number of instant payments has been phenomenal. And you can look at countries that have had growth in every other payment system. It's kind of like the adoption of cell phones. People didn't have landlines and then cell phones existed. And all of a sudden they just leapfrogged over existing tech. And the same thing happens in some ways in certain geographies where they may not have had such strong payment systems as other nations. But we need to make sure that our infrastructure handles those new payment rails, faster payment rails, and then all the settlement has to still occur. And not all of it occurs on the new payment rails. It occurs on the other ones. And that's why some of the reworking takes place. You asked a few questions, or I don't know that I got to all of them, but the idea that speed does matter. When payments are easier, there are more payments. And so you see that in your own personal life as a consumer. And you can see that on the business side. If there's a lot of overhead and there's a monthly cycle or a weekly cycle, there's no reason that cycle can't be faster and easier and more timely, with more visibility, with more data. All of those lend themselves to more secure, more end-to-end, better process supporting payment cycles. So I think there's a lot of promise. Your points about some of the banks not offering some of the faster areas, that's significant. And it's a partial concern. It's a concern for those that are slower because a significant portion of companies indicate that they will move to another bank among their creditor banks, or they'll shift outside their banking group to other banks or to non-banks. There's a willingness to move that's been higher than in the past, right? Credit drives much of the activity, but payments become increasingly important. So that's a significant concern. The other issue is, as banks change their underlying infrastructure to support that, they have to rely on their core system, their core banking system providers to stay current. And that's the only way they're going to get caught up is, when their providers upgrade their underlying system that supports more of a real-time, whether it's initiated by files, APIs, but this more dynamic and more 24/7 payment ecosystem exists. We all have to get there. The U.S. certainly has to get there. And there's certainly a gap being made between the banks that are staying current and those that aren't. And some of that's driven by the vendors and how they may have managed their technology infrastructure. We're going to see some gaps. Some of those may not ever be made up, and that'll create different situations for acquisitions of parties who aren't keeping up with the tech.
Well, you raised some interesting points, Craig. Finally, what is your choice for the biggest or most important story of the past week and why?
There's a couple of good stories there. The TIS story is very interesting in terms of how they're looking at the tech. I think that's, for any technologist or person who's thinking, needs to read that. The US Treasury buyback program, it's both interesting and a little concerning over time. I think we need to be mindful of that. I have to go with the AI and generative AI. That is technology that, in my view at least, is going to be the most significant and transformative technology that we've seen in Treasury for a really, really long time. I mean, I think it's more significant than delinking from the gold standard, from moving off of hard goods to coins and bills to move to digital. I think it's more significant than any of those areas, not only because of the extent of the change that it can bring about, but it's already bringing about that. And the expectations are high despite the level of worry and concern about it. And the other factor is how quickly it's being adopted. It's being adopted extremely quickly. It's being developed very quickly. And so that rate of change is far faster than anything that we've seen go on in the banking space for some time. So that's definitely my top story for the week that I would select for that. Doing the research, I had expectations. Seeing the level of, I'll call it enthusiasm or expectations, interest. What people are doing is they're piloting the use of this technology today. They're learning and getting their teams up and ready. And the majority expect to use it for key and crucial functions, payments, forecasting, and multiple other areas. So that's clearly number one. As I'm talking to you, it's become number one by 2 or 3-fold the other ones, just by the dialogue and what's going on in that space.
I couldn't agree with you more because the report does offer some very valuable insights, and I would recommend Treasury professionals to download the Generative AI in Treasury and Finance survey report from strategictreasurer.com. Well, we've come to the end of this podcast episode. Before we sign off, I'd like to express my gratitude to you, Craig, for joining us and enriching today's episode with your expertise and informative analysis. We would also like to express our gratitude to our CTM File audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.